Welcome to This Explainer. Okay, today we're taking a really fascinating and honestly kind of eye-opening look at something that is literally hiding in plain sight in millions of wallets right now. We're talking about the compounded cost of Indian credit card debt. So we're going to completely demystify the real hidden math behind those monthly credit card statements. Look, if you have ever stared at your bill and thought, wait, how on earth did the numbers get so high so fast? Well, you're definitely not alone. There's this whole invisible architecture of numbers at play, and today we're going to break the whole shebang down for you visually. So it really boils down to one simple question. How much is your credit card actually costing you? I want you to genuinely think about that for a second. Do you truly understand the exact financial weight of the debt you might be carrying from month to month? Because let's be real, most of us just glance at the minimum payment due, maybe sigh a little, and then just swipe again. But beneath that simple little transaction lies a mathematical reality that the banks know intimately. And you know what? It's high time you did too. Okay, let's dive into this, because this right here is exactly where the banks start their conversation with you. 42%. This is the annual percentage rate, or APR. You've probably seen it prominently displayed in all their shiny marketing materials, or maybe buried deep in those massive terms and conditions documents, and of course, stamped right there on your monthly statement. Now, I want to be perfectly clear right up front. This number is entirely accurate. The banks aren't technically lying to you. However, the way it's communicated, well, it's systematically deceptive. It basically tricks us into severely underestimating just how expensive that credit card interest actually is out there in the real world. And then, sitting right next to that big 42%, you'll often spot this second, highly visible number, 3.5%. This is the monthly rate. And this right here, my friends, is exactly where the grand illusion begins for Indian consumers. It's such a small number, right? It looks totally harmless. 3.5% feels super manageable. It almost feels like pocket change. But here's the catch. Presenting the cost of massive crippling debt as this tiny little monthly fraction triggers a huge psychological blind spot in how our brains process financial information. Now, here is the psychological trap we just immediately fall into. When most of us see 3.5% per month, our brains frantically start searching for a familiar reference point. And what is the absolute most common financial reference point in India? You guessed it, the humble fixed deposit. We think about an FD giving us, say, a solid 7% per annum. Subconsciously, our brains falsely anchor these two numbers together. We think to ourselves, well, an FD gives 7%, so 3.5% is just half of that. It's only moderately more than a good FD rate. This logic feels so right intuitively, but it is dangerously, incredibly incorrect. Let's break down exactly why that comparison just totally falls apart. Here's the first massive flaw in the whole FD comparison thing. We are literally mixing up apples and oranges here, or in this case, annual returns and monthly costs. See, that 7% FD rate is what you earn over an entire year. But the 3.5% credit card rate, that's what they're charging you every single month. So 3.5% per month is absolutely not just a bit more than your FD rate. When you actually look at the basic math, it is a staggering 6 times the standard 7% annual FD rate, just expressed on a monthly basis. We are talking about a completely different universe of money here. But wait, the math gets even more aggressive because of a second major flaw in how we perceive that rate. And it all comes down to one absolutely brutal financial mechanic: monthly compounding. Now, in the world of credit cards, each month's interest is added to your original principal balance before the next month's interest is even calculated. Think about what that really means for a second. You aren't just paying interest on the stuff you bought. No, you are literally paying interest on your interest. The debt actively builds upon itself every single billing cycle. It's just compounding silently in the background while you go about your daily life. Let's move to and see how this builds in a real-world scenario. Say you had to make a sudden emergency purchase, and it leaves you with a 1 lakh rupee credit card balance on January 1st. And let's say you make absolutely no payments. Just look at how this timeline unfolds over just the first 6 months. After month 1, you owe 103,500. Okay, not terrible yet, right? But watch the acceleration. After month 2, that 3.5% is applied to the new, higher balance, bumping it to $107,122. By month 3, you cross $110,000. And fast forward to month 6, you're sitting at nearly $123,000. Those numbers are really starting to evoke a visceral reaction, aren't they? That right there is the quiet violence of monthly compounding. Now, let's continue this little journey through the final 6 months of the year. The momentum is already locked in, and it's only going to get faster. We started month 6 at roughly $123,000. Well, by month 9, that same original 1 lakh rupee purchase has ballooned to over $136,000, and by the time we hit December, month 12, the compounding months stack up to a truly staggering $151,107. Think about that. You haven't bought a single new item. No new shoes, no fancy dinners out. You literally haven't swiped that card once in 12 whole months. But your debt? It's grown by more than 50%. And this brilliantly illustrates the core deception of that initial 42% APR we talked about. Look, if you took the bank's advertised 42% per annum totally at face value, you'd probably expect your 1 lakh debt to simply grow to 1,42,000 rupees over the year. And honestly, that already sounds painful enough. But then look at the compounded reality. A balance of 1,51,107 rupees. That gap right there? That is almost 10,000 rupees of entirely hidden financial loss. It's extra money pulled directly from your wallet purely because of the sneaky mechanics of monthly compounding. So the crucial point is this. The mathematical annualized equivalent of 3.5% monthly compounding is absolutely not 42%. We have to completely de-anchor ourselves from that heavily advertised APR. The 42% is just a nominal rate. It's the rate before the math actually happens in the real world on a month-to-month basis. If you really want to understand what a credit card actually costs to hold over a whole year, you simply cannot rely on the number they print in big, bold text. You have to look at the compounded reality. And guys, that reality is 51%. That is the alarming truth right there. The actual compounded annual cost of carrying that revolving credit card balance is a genuinely punishing 51%. When you leave a balance on your card, you are effectively taking out a loan at an interest rate of over 50% per year. I mean, that is a rate that outpaces virtually any investment return you could ever realistically hope to make. This massive distinction between the advertised 42% and the true 51% matters enormously to your financial health. Which naturally brings us to the most important question of all. Are you carrying a revolving balance? Because if you are, even a really small one, that 51% math is working against you right now every single day. The numbers on your statement are completely designed to look manageable, but as we've just seen, they are masking a compounded avalanche of interest. So I really want you to take this knowledge, apply it to your own wallet, and reevaluate your next monthly statement with a critical eye. Are you truly paying for convenience, or are you just trapped by compounding? Because remember, knowledge is only power if you actually act on it.